Okay, so good evening, everyone. So our topic for today is about real return or nomination return, or maybe somebody return of investment. No, so again, for today, of course, the real return is what is earned on an investment after accounting for taxes and inflation. So real returns are lower than nominal returns, which do not subtract taxation and inflation. Again, the nominal rate of return is the market rate of interest, while the real rate of return is an adjusted and realized rate of interest. So bank loans and interest rates are nominal rates of return, while the real rates are derived from the nominal rates. So to give us more details about the topic, let us all welcome our presenter. Go ahead.
Good evening, everyone. Our topic for tonight is all about real return. First is what is real return? Real return, it is an earned on investment after accounting for taxes and inflation. Real return are also lower than nominal returns, which do not subtract taxes and inflation. Like what said Sir earlier, real rate return is the annual rate of return taken into consideration after taxes and inflation. However, a rate of return that does not consist of taxes or inflation is referred to as a nominal rate. Next. Next is inflation. Inflation is a decrease in the purchasing power of money reflected in a general increase in the prices of goods and services in an economy. Nominal return may also refer to a rate that's been unadjusted for inflation. Therefore, the nominal rate of return is the amount of money generated by an investment before factoring in expenses such as taxes, investment fees, and inflation. Next is formula of real return. The formula of real return is real return equal nominal return subtracts inflation. The same calculation can be used for a bond fund or any other investment type. Similarly, the real yield is the nominal yield of a bond minus the rate of inflation. Next is the example of real return that will be discussed by Ma'am LB.
Good evening po. Example number 1, for real return. If you invest with a 5% interest, but there is an inflation rate of 3%, then you would have a real return of 2%. Example, if you invested 100,000 pesos with a 5% interest, then you would expect 105 in return, but a 3% inflation rate, you would have a real return of 102 because the real rate is always smaller than the nominal return. Here's the solution. Real return is equals to nominal return minus inflation. The nominal return is investment, 5% return during a year, minus 2% inflation. The real return is equals to 3%. Example number 2, Michelle.
Example number 2. Let's say last year I put $100 into some type savings account in a bank. Exactly 1 year later, that $100 has grown to $100, so I got a 10% return. Let's say that the inflation ended up being 2% between a year ago and today. If that's the case, what is $100 a year ago in today's money? If inflation was 2%, then $100 a year ago will buy you the same stuff that 102 would buy you today. Next slide is the solution. So if you look at things, that's the absolute dollar terms. Sorry. So if you look at things just in the absolute dollar terms, things have grown by $10. So I made $10 of an original $100 investment. So I got a 10% return. But what I want to think about that is really capture how much more I can buy with this $110 than I could buy with that $100 before. Next. Can I really buy 10% more goods and service today than I could a year ago? And to think about that, let's think about hypothetical inflation rate from last year to this year. So let's say that the inflation ended up being 2% between a year ago and today. If that's the case, what is $100 a year ago in today's money? Next.
Example number 3 is like real rate return. Miss So has kept $100,000 in a bank. The bank promises to pay a 6% rate of return at the end of the year. The inflation rate is 3% during a year. What would be the real rate of return? The formula of real rate return is equals to 1 plus nominal rate divided by 1 plus inflation rate minus 1. One is given, then the nominal rate is 0.06 divided by 1 plus 0.03 minus 1. The answer is 1 plus 0.06 equals to 1.06 divided by 1 plus 0.03 is 1.03 minus 1. The real rate return is equals to 0.0291 or 2.91%. Ayun lang po, sir. Thank you.
Okay, so again, our presenter discussed already on how to provide the two inputs of nominal rate and inflation rate, and you can easily calculate the real rate of return and the actually formula provided by our presenter. Now, maybe somebody are asking on how we'll be able to difference the nominal and real return, which is more important to a typical investor, because all answers, both the nominal rate is the actual return earned by the investor, and the real rate is the return performance of the investment in terms of constant purchasing power inflation. No? So real rate is more important. So if somebody ask what is better for the calculation of investment, in order to fully assess valuation, we would like to understand the advantage and disadvantages of the real versus nominal values for a calculations, of course. So for an investment, one should use nominal rate for short term, the same about, of course, the cost, and the real rate for long term investment, yung pension funds, for example. And why not real rate always because of the troubles in estimation of discount or the inflation rate in the future. Okay, then excuse me. How about, of course, the again, as what our presenter mentioned, no, the real rate of return is the annual rate of the return taken into considerations after taxes and inflation. Okay. However, a rate return does not consist of taxes or inflation is referred to as a nominal rate. So likewise, a real return that includes taxes or inflation is in each calculations is the real rate. Okay, so so how we'll be able to find a nominal? Of course, subtract the original investment, no, amount, as what our presenter mentioned, no, from the current market value on the investment. No? Then take the results from the numerator and divide it by the original investment amount. Okay, so I just want to share also the a short video. No, yes, it's correct. Yes, yes, Marv, it's correct. I just want also to share a video presentation about the really nominal return. Looking forward to be able to almost the same with the discussion, but I'll just want to show you and to give you an additional inputs related to this discussion. No.
Last year, I put $100 into some type of savings account in a bank. So this is a year ago. And that now today, exactly 1 year later, that $100 has grown to $110. So this is now. So if you look at things just in the absolute dollar terms, things have grown by $10. So I made $10 off of an original $100 investment, off of a $100 investment. So I got a 10% return. But what I want to think about is, does this really capture how much more I can buy with this $110 than I could buy with that $100 before? Can I really buy 10% more goods and services today than I could a year ago? And to think about that, let's think about, well, a hypothetical inflation rate from last year to this year. So let's say that the inflation ended up being 2% between a year ago and today. If that's the case, what is $100 $100 a year ago in today's money? In today's money. Well, if inflation was 2%, then $100 a year ago would buy you the same stuff that $102 would buy you today. So it would be $102. So what is the dollar return in today's money? Dollar return in today's money, in today's money, the current purchasing power. Well, we're getting $110. We get $110, and we invested in today's money $102. If we look at it from today's terms, we invested something that gives us the same purchasing power as $102 today, and now it's giving us a purchasing power of $110. So we've gotten $8 more of purchasing power in today's money. So what is the actual real return? So let me write it in real return, and we can do it in today's money. And you could do it either way. You could discount the 110 back to a year ago money and figure out the real return there, and figuring out the actual dollar return and do the calculation. Or you can do it today in today's money, and maybe I'll do it the previous way in the next video. But the real return is we made $8 over the course of the year in today's money, and what we originally invested in today's money was $102. $102. And so we get our calculator out. 8 divided by 102 is 7.8%. So this is equal to 7.8%. So even though the nominal return, the number, if we just look at what we got in exchange for what we invested, even though the nominal return was 10%, because there was 2% inflation, our actual purchasing power only increased by 7.8%.
Okay, so it's just only an additional discussions no related to the real return and nominal return, no. So sorry. Again, as what we discussed earlier, no, that the real rate of return is the annual percentage of profit earned on an investment adjusted for inflation already. Then therefore, the real rate of return accurately indicates the actual purchasing power of a given amount of money over time. So adjusting the nominal return to compensate for inflation allows the investor to determine how much of a nominal return is real return. So in addition to adjusting of inflation, investor also must consider the impact of other factors such as taxes and investing fees, no, to calculate the real returns on their money or to choose among various investing options. So the real rate of return is calculated by subtracting the inflation rate from the nominal interest rate. And it is more accurate measure of investment performance than the nominal rate of return. Again, the nominal rates of return are higher than real rates of return except in times of zero inflation or deflation. Sorry. So let's say, for example, in additional example of the real rate return, no? Assume a bond pays an interest rate of 5% per year. So if the inflation rate is currently 3% per year, then the real return on your saving is only 2%. Okay? So in other words, even though the nominal rate of return on your saving is 5%, the real rate of return is only 2%, which means that real value of your savings increase by only 2% in a year. So considered another way, assume you have, let's say, for example, 10,000 pesos to 10,000 US dollar, let's say, for example, to buy a car, no? But decide to invest the money for a year before buying to ensure that you have a small cash cushions left over after getting the car. So earning 5% interest, you have 10,500 US dollar after 12 months. However, because prices increased by 3% during the same period due to inflation, the same car now costs 10,300 US dollars. So consequently, the amount of money that remains after you buy the car, which represent your increase in purchasing return or purchasing power, is 200,000 US dollar, 2% of your initial investment. This is your real rate of return as it represents the amount that you gain after accounting for the effects of inflation. So again, interest rate can be expressed in two ways. Okay? Again, nominal or real rates. Again, the difference is that nominal rates are not adjusted for inflation, while real rates are. No? As a result, nominal rates are almost always higher, except during those rare periods when deflation or negative inflation takes hold. So, in the late 1970s and early 1980s, the profits on double-digit interest rates were eaten up by the effects of double-digit inflation. So an example of the potential gap between nominal and real rates of return occurred in the actually 1970 to 1980. No? So double-digit nominal interest rates on saving accounts were commonplace, but so was double-digit inflation. So prices increased by 11.25% in 1979 and 13.55% in 1980. So therefore, real rates of return were significantly lower than their nominal rate counterpart. So should an investor rely on the nominal rates or the real rates? Real rates give an accurate historical picture of how an investment performed, but the nominal rates are what you'll see advertised on an investment product. So another factors affecting real rate of return. So the problem with a real rate of return is that you don't know what it is until it has already happened. That is, inflation for any given period is a trailing indicator. Again, trailing indicator that can only be calculated after the relevant period has ended. In addition, the real rate return isn't entirely accurate until it is also accounts for other costs such as taxes and investing fees. So what is trailing? Okay. Trailing refers to the property of a measurement or indicator or data series that reflects a past event or observation. It is usually attached to a specified time interval by which the data trail or over which the data are aggregated sum or average. So trailing data and indicators are used to reveal underlying trends but can delay recognition of trend turning points. So trailing can also refer to a type of stop order used by traders. So again, a while ago, we have a differentiation of the real and nominal interest, nominal interest rate. So again, a real interest rate is an interest rate that has been adjusted to remove the effects of inflation to reflect the real cost of funds to the borrower in the real yield to the lender or to an investor. So a nominal interest rate refers to the interest rate before taking inflation into account. So nominal can also refer to the advertised or stated interest rate on a loan without taking into account any fees or compounding of interest. So again, maybe somebody asking, Doc, what is inflation? So inflation is the decline of purchasing power of a given currency over time. So a quantitative estimate of the rate at which the decline is purchasing power, no, occurs can be reflected in the increase of an average price level of a basket of selected foods or selected goods and services in an economy over some period of time. The rise in the general level of prices, often expressed as a percentage, means that a unit of currently effectively buy less than it did in prior periods. No? So looking to learn more about actually just trading and investing. No? So there are more than enough, no, to give you some additional input related to this topic. No? So I think that's it for this topic. Okay.